Hi, Tom. I can't wait to speak with you today. I want to know how you got into algorithmic trading because I know that you have a background in physics. Is that correct?
Yes, that's right. Well, thanks first of all for having me, and yeah, I really appreciate to be on your podcast. And yeah, it's true. I've got a background in physics. I did a physics PhD of all things, and of course, being a physicist is not an easy life these days, especially if you're an academic. And so, I was always interested in many different fields, and so I really was more into casting my web a bit wider and just seeing what's out there in the world and using what I've learned during my time in physics to apply it to other, maybe a bit more real world problems. So I guess that was my main intention with this. I think I'm just not genius enough to be a physicist in that regard.
What attracted you to trading?
Well, yeah, it's an interesting one. So I basically worked in engineering for quite a while, and on many different problems from jet engines to semiconductors. And I always worked a lot with computer simulations, and so I also used to do really quite large scale computer simulations on distributed servers, like literally hundreds and thousands of them. And at some point, I thought, well, if I have all this computing power and I have the understanding, maybe I can just build something that automatically trades the stock market and makes me money while I'm lying on the beach. And at the time, really, that was really before retail traders had any access to systematic automated trading systems. So it was like a crazy idea, but I got quite obsessed with it. I thought, oh, maybe I'm one of the first people that ever even thinks about that. And yeah, I got into it. I had no idea about finance or trading when I started. So I basically I'm entirely self-taught, and I absorbed, I don't know, unbelievable amounts of literature on trading and everything beyond and finance. And I guess now I could call myself reasonably competent in that field.
With that being said, you haven't really gone from the discretionary route, right? I know we had a pre-call previously where you said you've actually never traded maybe from a discretionary chart perspective, things like that. You've taken a completely different approach. Can you kind of tell me a little bit about that?
Yes, it's an interesting one actually, because I read a whole lot of books about discretionary trading, and how you interpret charts and so on. And quite frankly, I didn't understand any of it. I looked at this and I just thought that doesn't make any sense to me. I'm obviously I'm coming from a background where interpretation of data is important, in engineering and physics. And I looked at this and I really didn't understand the way traders were thinking. So what I basically concluded after reading maybe 10 books or so on that subject, I just don't know. I don't understand it. So I need to do something else. And, I thought I basically started straight away, just punching time series into my computer, into Python, analyzing them, looking how you analyze them, what you can do with it, predictive modeling, all that sort of stuff. And that made me feel a lot more comfortable. And it's interesting because I know there's a lot of discretionary traders that are incredibly good at this and they're making money. And to me, it always seemed a little bit more like a black art, or something like astrology or so. And I guess some people are incredibly good at that, but I'm definitely more drawn towards really hard, testable, fundamental things. So I ended up doing it that way, and also I looked into executing manually, and I found that extremely tedious, and I didn't really want to spend a lot of time on the computer. So I also straight away looked into what are the ways to execute in an automated fashion, and which was good in a way, because by trial and error and learning a lot of things, I actually learned quite a bit of computer science on the side as well, which helped me a lot to further on, to really get a broad view of the whole subject.
How about some of your early, I guess, trading strategies? What did they look like? Obviously, you're one of the first ones using big data, so to speak, and creating your trading strategies. What did you find early on, and did it work out for you?
Well, I actually I literally started with a moving average crossover. So at the time, there really wasn't a lot of information out there on this subject. So there was really just 2 or 3 bloggers that really talked about this, and then I joined them as a blogger as well, in the hope that maybe some people have come and have discussions with me about these things. And so I really just started with extremely simple things, and looked like how well do they work, and I went basically through the whole sort of traditional technical indicator world, and looked at all these, and found, it sort of works, but it's not great. And then, slowly started combining that with more statistical methods, tools, and it just really went from really simplistic to more complex. The interesting thing is that as you go, there is a sort of inflection point where suddenly you start to everything becomes more simplistic again, but not simplistic in the way where you started, as basically as the fool that doesn't know where to go. You suddenly have a much more deep insight, and the simplicity comes from your understanding of all the things that don't work, I suppose. And so, yeah, so I went from more complex, again, to probably more simple, but not simple in stupidly simple, but more the sort of educated side of simple, I suppose.
Sure, that's great. So I guess in regards to today, what are you doing that obviously isn't too simple, but it's fundamental in nature to the markets?
Yeah, so I mean, a lot of what I do really involves, because I build strategies that can handle very big volumes, and large amounts of capital. And so there's a few challenges in that, and the challenges are mostly not coming up with a trading strategy that rules them all, but it's more about managing the risk appropriately, managing the portfolio, and also understanding how execution, or what execution does, how that skews the portfolio performance, and then of course scaling up and down. So I would say, like, when the underlying trading strategies that are generally used, that they're not particularly complex, but the complexity comes with the implementation of it. As I said, making sure the risk is appropriately managed, the portfolio positioning is really well done. All these things, they are the things that are, in my opinion at least, far more important than coming up with some combination of whatever indicators or so. That's almost the easy part, and that's the quick part. Then the more difficult part comes into adapting a strategy that you want to trade to a specific, I guess, risk benchmark, or risk assignment, to the capital that you have, and into other constraints that you may have, trading other people's money.
And you bring up a great point, obviously, a portfolio, which I think that's, from my understanding and discussions with other people, that's where you want to head to eventually as a trader, is a portfolio of uncorrelated strategies for multiple reasons. But where would you say for a new trader, what direction would you point them into if they were going to start trading?
Okay, so let me perhaps point out two things. First of all, Harry Markowitz, a famous Nobel Prize winner, said diversification is perhaps the only free lunch in finance. And coming from a Nobel Prize winner, I think he wasn't that too wrong with this. So whether you are a small trader or a big gun, trading a couple of $1 billion, whatever, it is still interesting and important to understand that diversification can help extremely in the performance of anyone's trading. And the other thing is that there is a book which is, I call it always a little bit the Bible. It's a book by Grinold and Quant called Active Portfolio Management, and they have in there an equation which is called the golden rule of asset management. And what it says is IR, which is the information ratio, or also the Sharpe ratio, or risk-adjusted return, equals the information coefficient times the square root of breadth. Now, that sounds a bit like a handful, but what this means is that your risk-adjusted returns are sort of consist of two components. One is the information coefficient, which is really the skill that you have as a trader, and the breadth that you have. Or you could almost say this is a proxy, not exactly the same, but a proxy for how diversified you are. And so diversification is not just like different assets, it's different asset classes, different time frames, different strategies, all this sort of jazz. So there's a lot to diversification. But what's interesting about this is people say, like you mentioned Warren Buffett, they are incredibly skilled in picking the right stocks, or at least I think they are. And so their information coefficient is very high, but their breadth is really low. But for, a lot of people, including myself, where my skill isn't particularly great, we need to, in order to get better performance in terms of risk-adjusted returns, we need to increase the breadth of our strategy. So that's why this is important. And of course, that only scales with the square root. So we're not, it's not linear, but nevertheless, I think even if you're starting out, it's worth a consideration that rather than trying to find the one strategy that rules them all, you may consider actually, not building or not trying to find that amazing strategy, but actually combining a few strategies and getting better performance that way. I think this is probably something that I learned not too early, and I wish I had known this earlier.
That's funny that you mentioned that. Did you try coming up with initially a holy grail strategy?
Of course. Of course I did. And it's quite a sobering experience. It's actually quite interesting. And I've built this system that basically generates hundreds of thousands or millions of strategies randomly. And they're all like just trading strategies. And what you see is that or you would expect that when you do this randomly, there would be some single strategies that actually perform really, really well. And of course, some of them do okay. But what's fascinating is that there is some sort of a limit of how good the performance can be when you have a strategy that is purely based on historical price data. So in a way, when you look at historical price data, the out of sample predictions that you can do, at least from my gut feeling, there is actually a limit of how or what you can achieve. And obviously this limit changes over time, but it's definitely visible in what I've seen so far. So my feeling is, of course, in sample, you can build strategies that return unbelievable amounts, but out of sample, I do think there is really a limit of how well a strategy can perform. And I'm not sure exactly what that is yet. That's probably for the academics to work out.
No, that's really interesting. Yeah, I still remember, my first trading strategy where it ended up getting so complex that by the end of it, I didn't even remember what I was doing. Right. Then I've come to learn that a diversified set of strategies is for multiple reasons the best way to go. But that's really interesting. The point that you bring up about those random strategies. What do you think the cause of that? Do you think it's because the market participants learn, and then the strategy sort of comes discounted in the price, or due to history, or what's your thoughts?
Well, I mean, first of all, the amount of information that you can extract from historical performance is obviously limited, and there's clearly events that are not related to the historical performance of your price data, which play quite a significant role in the movement of stock market or whatever asset prices in general. So, even let's just use the example of insider trading. If there's some insider trading happening, this cannot be included in past prices. So whatever you extract from there has got a very strong limitation, and so that will always mean that what the amount of information that you can extract will always be suboptimal. It will never be perfect. And so the key is to question, how can I extract enough information from those series to build a strategy that is good enough for my needs. And often, and as what you said rings very true for me as well. I started building strategies more and more complex, and realized, well, this is really not the way to go. Because what happens is, yes, they work well in backtests, but the predictive power of them, the out of sample information that carries through to a market yet unknown, is quite limited. And it turns out that often comparatively, not extremely simple, but comparatively simple things can be hugely effective, rather than trying to make things too complex. The complexity is really, it's an interesting bias in our mind. We see those historical price charts and we say, well, if we add something here and we add a moving average filter there and some other filter here, oh, that must be, we get the perfect thing. But this is just not quite how it works. And I mean, anyone who's done a bit of quant analysis obviously knows that quite well.
Yeah, that's funny. I feel like it's almost a rite of passage. You have to discover that eventually. But no, that's great. So I guess in regards to a strategy, what do you what do you consider a strategy whenever you're thinking about randomly generating all of those strategies?
Well, so first of all, for me, I don't think in terms of entries and exits. So this is something that I had to let go reasonably early on, because I mean, and I'm not saying it's wrong, but it's just not the way I think. The way I think is in terms of rebalancing portfolio positions. So my strategy is usually that portfolios and then these positions change. So there isn't really an entry and exit as such. You always have some sort of position on, and then it scales up and it scales down, and that scaling is driven by a few factors. One of them is obviously a predictive model of some sort. So and this is where the creativity obviously comes in, from a trader to find interesting predictive models that have at least a little bit of alpha in them to make them worthwhile. And then, of course, you can combine them and do whatever you want with them. But then the second part that I think about is, how do I then take those predictive signals and tie them into my portfolio? So basically, these predictive signals then inform how I position myself in the market with each different product that I trade. So I need to think about, it's effectively position management. How do these signals then come into building my portfolio? But of course, portfolio building isn't just about the predictive signals. It's also about how much risk do you want to take with a single position and so on. So basically, the second step is really thinking about portfolio construction and portfolio management. And a lot of people have heard of the mean variance portfolio, which is sort of the most basic idea in portfolio management, which I think also comes from Harry Markowitz, which I mentioned earlier. But then there's obviously more sophisticated ways to do that. You can use Kelly, which in some edge cases actually converges to a mean variance portfolio. But you can also use something like deep learning, and I've actually put out a new course recently on Quantra, or it's actually just coming out now in end of January, about using deep learning. Now, I was always a little bit skeptical about deep learning in finance, but what you find is that if you set it up correctly, it can actually perform better out of sample than your standard mean variance portfolio stuff. Now that's the second part, but then the third part is execution. So execution is something that is often quite neglected by traders. They go, well, we cross the spread, we get filled, but we lose quite a lot of money with that when we cross the spread, because you're paying for the privilege to execute in that moment. And therefore, if you actually think about execution systems, especially when you trade quite large amounts of capital, just not crossing the spread all the time really can save you millions of dollars per year. But even for a retail trader, when you have a strategy that seems to perform well, but it's very the profits per trade aren't that great, having a good execution where you don't cross the spread all the time, but you're quoting also, that can really help to improve the performance of the strategy. So these three components, I guess, are the main ones that I think about when I build a new strategy.
That's fantastic. Yeah, I'm excited for your new course. The first course that I took of yours a while ago was on the neural networks and reinforcement learning. I tried forever to build a reinforcement learning strategy. Yeah, which I thought your course was fantastic, by the way. That was my first introduction. The challenge that I realized after doing it, of course, was that even, and again, this is when a portfolio comes into play, even when you come up with a strategy that works, you have no idea why it works. And I just don't know if you have this staying power to keep it on. So I think from that perspective, what's your thoughts about where AI is taking trading, and what's the room for discretionary or algorithmic traders to start using some of these AI tools?
Well, first of all, I think AI, at least in finance, is a little bit overhyped. I'm always very skeptical about anything new and anything complex for that matter. The way I see AI is really purely as a tool, as a means to an end. Now, it's interesting because you see a lot of the young data scientists that come onto the scene and they're claiming, oh, I built this AI tool that can beat the market by a huge amount and all this. Every single paper that claims that I've seen so far, I could very easily debunk. It doesn't take much. But that is not to say that AI isn't something worthwhile. It definitely does something interesting, which is it also takes into account nonlinear correlations in the price data. So ultimately, what you need to, the way you need to think about is, if you want to build trading strategies purely on price, is that you're really just working with correlations within the data, and the traditional way to do it with most indicators and so on is fairly linear, and then some indicators and then AI tools, they actually extract nonlinear correlations. And so the way I see it is really, it's in some ways, I always call this a more glorified regression engine. And I'm definitely not overly excited about it, but I'm happy to use the tools if they help me. But as I said, you got to be really careful about this. To say, well, what I really want is a trading strategy that is based on reinforcement learning, but you don't really have anything else, it's probably not right. You need to first come up with some ideas of what it might be, and then say, well, how can reinforcement learning help me to support my investment thesis and my goals, and then apply it that way, rather than starting with reinforcement learning, which is what a lot of people do. They just get so excited about those AI tools and they start with them. And in my opinion, at least, that's not a good approach. I think the best approach is to start with a solid idea of some description, and then pick the tools that you want to achieve that. And so that way, it is much more robust. It is much easier to achieve what you want, rather than just getting excited about the tool. It's a bit like, someone gives you a hammer and a chisel, and you say, "Whoa, I've got a hammer and a chisel now. I sculpt the most beautiful sculptures," and that's just not how it works. You need to first have a concept of what you want to sculpt, and some sort of artistic ability, and then the hammer and the chisel is just a tool. It's not what actually makes the sculpture work. I'm not sure that makes sense, but I hope.
From my experience, it makes perfect sense, right? Everyone wants to just create this black box that prints them tons of money, but it just doesn't work that way. But there are some use cases.
The use case for portfolio management is pretty strong, but another place where those tools can be very handy is in execution. And so there's quite a few problems in execution where reinforcement learning, but I have to say not deep reinforcement learning, but standard reinforcement learning is very routinely used. And it's relatively easy to see that this could be extended to deep reinforcement learning. The only issue with that is that often execution relies on low latency. And one of the reasons why deep reinforcement learning hasn't been used so much in execution yet is because it's comparatively slow, and it really it really destroys your latency. So once we get faster machines and faster calculations, I'm pretty sure that will creep in slowly as well.
That's great to know. In regards to your back testing, what platforms or systems are you using? Are you just using pandas, or what are you doing there?
So I built all my backtests from scratch in Python. I don't use platforms myself. It's a practice that I started reasonably early on, because what it does is it really forces you to always reconsider what you're actually doing every time. And every time you build a backtest, you get a little bit better than what you built before. So you get a real routine in building backtests quickly, and you can build all the assumptions that you want to make in yourself. One of the issues that I found with platforms quite often is that there is inherent assumptions in the platform which are not necessarily always clear and obvious, and the code is often not open source, and so it's actually very difficult to see in the end whether your profits and losses come from your strategy that you tested, or they come from inherent assumptions in those platforms. Now, of course, they are very convenient, but I never felt like the convenient route is the one for me. So I definitely build backtests myself. And one word to backtests. One of the standard practices that I use is I always very cleanly separate the signal generation, so the predictive part of the modeling, the portfolio sizing, and the execution from each other. So I usually not mix them up in my backtests. So once I have my predictive signals, then I move on to the portfolio construction, and then once I have that, I look at the execution. But I try to really have a clean separation and not a mix up, because it just gets too complicated and confusing, and my little brain struggles to hold that all in one place. So I rather do it step by step, and it makes it a lot easier to understand and to deal with. And you can also see, well, okay, what is the P&L that is generated by my signals? What's the P&L that is actually generated by doing my portfolio management? And the same with execution. You can really see where the source of your performance comes from, rather than mixing it all up and then having no clue. And then you can tweak so many buttons at the same time that it's almost impossible to find a really good sweet spot in that.
No, that's great. I agree with that advice too. I started with a platform, and if I could do it all over again, I would definitely go with just Python and Panda, simply because I think you gain another skill set that's more broad, and there's just so many ways to use it. But then that brings me to the question: what about execution? Do you then take that out the algorithms and move it to a different system, or how do you go about doing that? Just because of the risk of coding errors when moving it to another platform.
Well, it obviously depends. Like when I'm putting my retail hat on, probably a good way to do it is to have some sort of system that generates signals and does the portfolio sizing and so on. And then you probably want to build something like a separate system that handles the execution, and then have them communicate. So in today's computers, there's nice packages and tools like ZeroMQ also, that have different programs communicate with each other, for example. And so what you can do is you can actually build some sort of execution system, and all you need to do is just supply that with market signals, and then it handles everything else for you, and you don't need to worry about it so much anymore once it's done. And I think it's a really good way of doing it. And a lot of the brokers that today they also have execution algorithms that often give you a better executed price than you would normally be able to achieve when you just cross the spread. So if you're not yet want to build your own execution algorithms and deal with that, a good way to do it is to use someone else's. And yeah, a lot of brokers, like, I mean, I'm not affiliated, but for example, like just what I know, IB, they have a whole suite of execution algorithms for free for anyone to use. And you just go and pick what you think suits your needs the most. And I think it's a good way of doing it. Of course, when people start really early on, I also tell them maybe it's actually a good idea to start with manual execution first, to actually submit your trades by hand, just to see what happens, because there's a whole lot of issues that can arise from automated execution. And the last thing you want is to have an error in your code, and then suddenly you have a million orders in the market, and you don't know how to close them out again, something like that. I mean, most risk engines will prevent that, but there's definitely been these cases where this was so, and firms got completely obliterated. I mean, Knight Capital is a famous one, but there's plenty of others where the same thing happened as well. And it can happen in retail too. So, now the other thing is using a platform is a bit more straightforward. And And I'm not saying you shouldn't use platforms. I think platforms have a really, really important place, and they make it a lot easier. And sometimes I look at my code, and I write decent code, but it's probably not amazing. And I think, man, I should just use a platform. This is just so what a mess. So if you can do that, obviously the platform should have a backtesting facility and then you can maybe compare your initial simulations with the backtests in the platform and see whether they agree, which is actually more tricky than it sounds. But there's obviously ways. So I wouldn't say, oh, don't use a platform, but yeah, there's alternative ways, and I guess for me also, I love learning. So learning all these alternative ways is really cool because you learn a lot of skills with it. Computer science skills and algorithm skills and all that, which are extremely handy in the long run.
Speaking of technology, what advances in, machine learning, crypto, or anything like that do you think, that could be interesting in the future for algorithmic traders?
Good question. It's really difficult to know that, because as the technology changes, the market changes, and so there's always this ongoing. It's almost an evolutionary process of predator and prey, right? We have, I suppose, the predators, which is the people with the technology, and the prey is the market and the other people. And so it's really difficult to know what's going to be um, interesting going forward, because when you actually look at evolution, it's fascinating. You see that in as far as I understand it, and I'm definitely not very good in sort of biology or all this, but the way I understand it is we evolve to more and more complex life forms up to a point where complexity actually is becomes destructive, and then the whole system starts to collapse and reset in a much more simple system, which then evolves again, and so there's this constant this constant cycle of increasing complexity and then collapsing complexity. So I can easily see that this could happen in the market as well. That at some point the complexity becomes so huge that it actually somewhat collapses and resets itself to start from a less complex stage again. And because of that, I really wouldn't want to even start to predict what is going to happen in the future in financial markets or with tools. I mean, there's obviously interesting stuff like quantum computing and the really deep machine learning algorithms, but you know there's there's many there's many aspects of that I'm very skeptical about. And I don't know if you heard this, but only a couple of days ago, Google researchers came up with a paper that actually shows that even those really, really deep models um, have not the ability to think outside of the box, as you will. So they're only really reasoning on what they know, but they're not able to come up with things that they haven't been trained on at all, not even simple things. And I think this is really interesting because, yeah, you've got all these complex models, but at the end of the day, they only know what they know. And the ingenuity of humans is that they can come up with stuff, outside of the box quite a lot. And this is what really pushes things forward in reality. And so, yeah, tools are all great and they're going to be more shiny and more fantastic. But I think the human mind will still be the ultimate defining uh, property. And the recent Google paper again showed that we're not actually that much closer to this general intelligence. So I don't necessarily hold my breath for that to happen anytime soon.
No, that's great. I would love to check out that paper. Yeah, it's interesting because I think about this a little bit too. Straying a little bit from trading, but it's how unique are we as humans? When you really look at how the mind works and neural networks work is very interesting. And I have a young daughter, and I just remember when she was learning, just how to feed herself and walk. It was a lot of repetition. I'm like, this is, this is back propagation. And I'm just thinking, like, hey, are we really, really that unique?
I think there is a lot more to the human story that we think. I've seen once a paper where researchers actually looked at brain connectivity, and they used MRI scans or some technique like this to look at how messages get sent in the brain, and it was very chaotic. But what they then did is they actually mapped the space to a 7, I think, and an 11-dimensional space. So they mapped all the signals, instead of like the 3 dimensions in the brain, to some 7 and 11-dimensional spaces, which is some mathematical procedure I don't understand. But it turned out that suddenly, when they did that, everything made perfect sense. Everything was very regular. And that is not something that a neural network can actually do yet. We're far from that. So the neural networks that we use in the computers, they're not necessarily higher dimensional, or they don't act as sort of higher dimensional entities, as far as I understand. So I think there is still a lot more to discover in the human brain that isn't there. We're not quite there yet with our computer technology.
Tell me a little bit about what you're doing currently. I know that you've got AAA Quant. You're doing a lot of great courses on Quantra. Can you give us a little bit about that?
Sure. So yeah, AAA Quants. It's my consultancy company. So I provide consultancy for financial institutions and so on. But recently I've also focused quite a bit on educational stuff. So I built a few courses, and as you mentioned, recently I built a course for Quantra on using deep learning for portfolio management. But also, I don't know if you heard it, but Quantopian has come back up again. They're back online, and I don't know if you noticed, but I used to work quite a bit with Quantopian before they disappeared. And so now they're back, and they started, or the CEO Force started a new platform. And so I was always I always loved Quantopian, and I loved working with them, and I ran workshops for them. And I'm actually really happy to be back. So if anyone's interested, check out Quantopian. There's some, it's still small, relatively small, but there's some amazing people on there, and it's gonna be really interesting as well. And it provides, these places, they provide very different, I guess, very, very different themes in the quant finance world. So Quantra or Quant Insti or Quantopian or so. That and I'm always happy to be involved, because at the end of the day, I'm learning so much from that as well. So it's really worthwhile spending the time. Now I'm also building quantitative or alpha models. As I said, this is one of my jobs for a large financial institution. So that's a little bit outside of the other things, but that's actually an enormous amount of fun too. And I think when you provide education, it's always good to also walk the walk and not just talk the talk. What I see is that a lot of the people online, they talk a lot about this, but they don't necessarily actually do the trading or do the research themselves. And I mean, I would say my workshops, they're not necessarily very slick or smooth, but I try to provide a different edge from someone who actually works in that field actively. So there's a place for everything in the world, and I'm having a lot of fun with it.
That's wonderful. And no, I am super glad Quantopian is back. That was kind of where I got my start, and there was so many great people that I've lost touch with that were on there, and hopefully it'll make a comeback. And I also saw you've got a lot of videos that they're coming out recently.
Yeah. So it's quite a bit on YouTube for free. So the idea was, a friend of mine, he's a good friend. He wanted to learn more about quantitative trading. He's got a programming background. Did extensive programming, studying programming, but he didn't know anything about it. And I said, well, let's just sit down and I'll teach you some. And then I thought, well, why don't we record it and just post it on YouTube? So it's not super slick, but what it does is it really I really take him through basically quantitative trading from absolute zero, and step by step basically teach him stuff that you really need to know. And I think if you can deal with the fact that it's myself and Josh, uh, being two nerds talking about this, I think there is a lot of really interesting information in there. And yeah, check it out if you want. I think there's actually a lot of really cool snippets in there to learn, and especially if you start afresh and you want to go down the more, I would say, quote unquote, the hard way. That's probably a good place to start.
Nowadays, it's wonderful to have YouTube and be able to have great resources like that. So thank you from all the beginners that are going to try that out.
Sure. I mean, it's actually a lot of fun to do this as well, because it makes me often question, what do I know, and go back to the real basics. And it's always a two-way learning in some sense. And that's why, partly why I'm doing it, because even if this is not stuff that is completely new to me, I'm still learning new things while I'm doing it.
I find that teaching and or writing about something clarifies your thoughts, right? For sure.
Absolutely.
All right, Tom. As we wrap up our interview, can you share maybe one alpha drop or some unique insight, or maybe a controversial insight that you feel that maybe isn't widespread or widely known?
Okay, yeah, let's do this. So this is actually really, really interesting. I don't know if you heard of this idea in machine learning that came out only in the last 2 years, I think, called double descent. So it's basically, some people wrote papers on the fact that when you have a AI model or machine learning model, as you increase your features, or the number of your features, your error will basically drop first of all. But then, as the number of features increases, the number of data points that you have, so the data size of the data set, the error will go up again. So you will basically, like if there's too many features, your model won't be as good, because you're just adding stuff that isn't really relevant. But what's interesting is, if you keep going and you actually increase the number of features beyond the size of your data set, so actually it's like really big ones, the error will actually drop again. And so that's a very fascinating thing. And it's been also shown in finance recently that these large models with like a large number of fairly nondescript input features can actually outperform smaller models. And so there's a lot of theoretical ideas behind why that could be the case, and so on. And ultimately, I think no one fully understands why this is happening yet. But for those of you who are into AI and machine learning, it's extremely counterintuitive to any sort of conventional wisdom that I've known, and most people. But yeah, it seems like this is the new interesting thing to look at and to work on. So I'm actually doing a discussion of a paper on that on the Quantopian platform on the 26th of January, I think. So what we're doing is we're actually just picking papers that are interesting, and then we have a live discussion around those. So I think it's it's pretty fascinating, and definitely worth, for anyone who's in that field, worth looking at.
That's great. But speaking of great discussions, I really appreciate your time today. I think there's a ton of value.
Definitely. Thanks for having me. Have a really lovely new year, and we'll definitely stay in touch.